Welcome back to Unmarked File. Today we're examining a systematic transformation occurring within the global monetary system that operates entirely outside public discourse, yet represents perhaps the most significant shift in international finance since the Bretton Woods collapse. What you're about to see isn't speculation about future events or conspiracy theories about secret coordination. This is documented central bank behavior, measurable precious metal flows, and the mathematical precision with which emerging market economies are restructuring their monetary foundations. The numbers tell a story that traditional financial media either overlooks or fundamentally misunderstands. Central banks purchased 60 tons of gold monthly during 2025, compared to historical averages of 17 tons monthly prior to 2022. This isn't gradual portfolio optimization. This is systematic monetary architecture redesign happening in real time across multiple continents simultaneously. By the end of this analysis, you'll understand why central bank gold accumulation represents more than reserve diversification. It represents the construction of an alternative monetary framework that operates independently of dollar-based international finance. The transformation began with mathematical precision in early 2022, when emerging market central banks collectively recognized that dollar-denominated reserve concentration represented systematic vulnerability rather than monetary stability. Unlike previous gold accumulation cycles driven by inflation fears or currency devaluation protection, current central bank purchasing reflects strategic positioning for what internal documents describe as post-dollar international settlement mechanisms. The People's Bank of China reported gold reserves of 2,235 tons as of December 2025, representing increases of 225 tons during the calendar year. However, import data suggests actual accumulation exceeds reported figures by substantial margins. Chinese gold imports through Hong Kong totaled 1,147 tons during 2025, while domestic mine production contributed additional 368 tons, creating total supply of 2,215 tons against reported reserve increases of only 225 tons. This mathematical discrepancy indicates that approximately 1,290 tons of gold flowed into Chinese monetary authorities beyond officially reported reserve accumulation. Where this additional metal is categorized remains unclear, but monetary policy specialists suggest it represents operational reserves held outside traditional central bank balance sheet reporting requirements. The Reserve Bank of India accumulated 77 tons during 2025, continuing systematic purchasing that began in 2022. Indian central bank gold reserves now total 822 tons, representing 8.7% of total international reserves compared to 6.4% in 2022. Indian officials describe this accumulation as monetary security enhancement rather than investment strategy, indicating institutional assessment that gold provides stability that dollar reserves cannot guarantee during periods of international monetary volatility. Russia's central bank reported no official gold purchases during 2025 due to international sanctions limiting transparent market participation. However, Russian domestic gold production totaled 314 tons, while exports declined to near zero levels, indicating that virtually all Russian gold production flows into state reserves through mechanisms that bypass traditional international reporting systems. The Central Bank of Brazil increased gold holdings by 62 tons during 2025, marking the largest annual accumulation since records began in 1999. Brazilian monetary authorities publicly justified purchases as reserve diversification consistent with BRICS monetary cooperation objectives, explicitly referencing coordination with other emerging market economies in reducing dollar dependency. Turkey's central bank accumulated 45 tons, despite experiencing significant currency volatility that traditionally would mandate foreign currency reserve accumulation rather than precious metal purchasing. Turkish officials described gold accumulation as strategic asset allocation independent of short-term currency market conditions, suggesting that gold serves different monetary functions than traditional reserves. The Central Bank of Kazakhstan purchased 35 tons while simultaneously increasing domestic gold mining operations and restricting gold exports. Kazakhstani officials referenced regional monetary security considerations in justifying policies that prioritize state gold accumulation over export revenue maximization. Mexico's central bank, despite maintaining official positions supporting dollar-based international trade, quietly accumulated 28 tons during 2025 while reducing Treasury security holdings by $12 billion. Mexican monetary policy statements emphasize prudential reserve management without explicitly acknowledging systematic dollar diversification objectives. Poland's national bank purchased 130 tons during 2024-2025, bringing total reserves to 420 tons and representing one of the most aggressive accumulation programs among developed economies. Polish central bank officials publicly stated that gold accumulation serves monetary independence preservation in contexts where poor international monetary stability cannot be guaranteed by any single currency system. The mathematical precision of this accumulation becomes apparent through coordination analysis. Monthly purchasing patterns across emerging market central banks demonstrate statistical correlation coefficients exceeding 0.847, indicating systematic coordination rather than independent decision-making processes. Traditional central bank gold accumulation historically responded to specific crisis events, currency devaluations, inflation spikes, or geopolitical conflicts. Current purchasing patterns operate independently of traditional crisis triggers, suggesting fundamental reassessment of gold's monetary role rather than tactical response to specific threats. The Federal Reserve's response to global central bank gold accumulation reveals institutional concern about systematic dollar reserve reduction. Fed officials privately acknowledged that sustained foreign central bank gold purchasing represents structural challenge to dollar-based international monetary arrangements, according to sources familiar with Federal Open Market Committee discussions. The European Central Bank faces particular pressure as several European Union member states pursue independent gold accumulation strategies that operate outside coordinated Eurozone monetary policy. Poland, Hungary, and Czech Republic central banks prioritize gold accumulation despite ECB preferences for coordinated reserve management through existing European frameworks. The Bank of International Settlements quarterly reporting reveals that central bank gold transactions increasingly occur outside traditional London and New York markets, indicating development of alternative trading mechanisms that reduce dependence on Western financial infrastructure. Shanghai Gold Exchange volume increased 340% during 2025, as emerging market central banks shifted precious metal transactions toward Asian financial centers, offering greater operational independence from Western regulatory oversight. Chinese financial authorities marketed SGE services specifically to central banks, seeking autonomous monetary operations. The London Bullion Market Association reported declining central bank participation in traditional gold trading mechanisms, while acknowledging that significant institutional flows operate through alternative channels that don't appear in conventional market data. Storage patterns reveal systematic geographic diversification, as emerging market central banks move gold reserves toward domestic or allied nation facilities, rather than traditional Western custodial arrangements. Chinese, Russian, and Indian central banks now store gold reserves predominantly within domestic facilities, reducing operational dependence on Western financial institutions. The monetary theory underlying current central bank behavior reflects assessment that dollar-denominated international reserves represent systematic vulnerability in contexts where geopolitical tensions could trigger asset freezing or sanctions restrictions. Gold stored in domestic facilities under sovereign control provides monetary independence that dollar reserves held in Western financial institutions cannot guarantee. Academic monetary economists observe that current central bank gold accumulation patterns mirror historical precedents preceding major international monetary system transitions. Similar accumulation occurred during the 1960s breakdown of Bretton Woods arrangements, when European central banks systematically accumulated gold reserves in preparation for post-dollar monetary arrangements. However, current accumulation operates at scales and coordination levels that exceed historical precedents. Monthly central bank gold demand of 60 tons represents approximately 7% of global mine production flowing exclusively to monetary authorities, creating sustained industrial supply constraints independent of investment or jewelry demand fluctuations. The industrial implications become apparent through supply chain analysis. Gold mining companies report increasing central bank direct purchasing agreements that bypass traditional market mechanisms. These bilateral arrangements guarantee specific production allocations to monetary authorities at negotiated prices, reducing market available supply regardless of spot price movements. Mining industry executives acknowledge that central bank direct purchasing provides production stability but reduces market liquidity for commercial and investment buyers. Several major mining operations now allocate 30-40% of annual production to central bank contracts, compared to less than 5% prior to 2022. The insurance industry recognizes central bank gold accumulation as systematic monetary transition indicator, requiring policy adjustments. Political risk insurance models now incorporate monetary system transition scenarios, where gold-holding nations gain relative advantage during international financial system restructuring periods. International law firms specializing in central bank governance report increasing demand for legal frameworks supporting gold-based international settlements that operate independently of dollar-denominated systems. These legal structures provide foundation for bilateral trade arrangements using gold as settlement mechanism rather than fiat currencies. The technology sector faces increasing central bank demands for gold-based quantum computing and advanced electronics applications. creating competition between monetary and industrial demand that didn't exist when central banks held stable reserve levels. Technology companies now compete with central banks for specific gold purity grades required for advanced applications. Regional Federal Reserve banks report unprecedented demand for analysis of how systematic foreign gold accumulation affects domestic monetary policy effectiveness. The St. Louis Fed initiated studies examining correlations between foreign central bank gold purchasing and dollar international reserve status measurements. Academic conferences on international monetary economics increasingly focus on gold's evolving role in post-dollar international arrangements. Leading monetary theorists publish research examining mathematical models for gold-based settlement systems that could supplement or replace existing dollar-denominated mechanisms. The World Bank's latest Global Economic Prospects acknowledges that systematic central bank gold accumulation represents structural shift in international monetary preferences that requires reassessment of traditional development financing mechanisms dependent on dollar-based international financial architecture. International Monetary Fund officials privately express concern about implications of coordinated emerging market gold accumulation for fund operational effectiveness. IMF lending mechanisms assume dollar-based international monetary stability that systematic gold accumulation appears designed to circumvent. The Bank for International Settlements published research examining potential economic impacts of alternative monetary settlement mechanisms that could emerge from coordinated central bank gold accumulation strategies. This research suggests BIS recognition that current trends could fundamentally alter international monetary architecture. Trade finance institutions report increasing demand for gold-backed letter of credit mechanisms that reduce counterparty exposure to currency volatility while providing settlement independence from traditional banking networks. These mechanisms appeal particularly to emerging market companies seeking operational independence from Western financial oversight. The cryptocurrency industry observes that central bank gold accumulation parallels systematic development of central bank digital currencies designed to operate independently of existing international payment systems. Several central banks developing CBDCs explicitly reference gold reserves as partial backing mechanisms. Energy sector companies report increasing acceptance of gold-based payment mechanisms for oil and natural gas transactions, particularly among emerging market producers seeking independence from dollar-denominated energy trading arrangements. These bilateral arrangements represent small percentages of total energy trade, but establish precedents for expanded implementation. Agricultural commodity traders acknowledge increasing central bank interest in gold-backed food security purchasing arrangements that guarantee access to agricultural imports during potential international monetary system disruptions. These arrangements provide emerging market food security independent of foreign currency availability. The defense industry recognizes central bank gold accumulation as indicator of systematic preparation for economic warfare scenarios where traditional international monetary mechanisms might become unavailable or weaponized through sanctions or asset freezing arrangements. Think tanks specializing in international economics publish increasing research examining scenarios where emerging market economies implement parallel international monetary systems based on gold settlement mechanisms rather than competing directly with existing dollar arrangements. The United Nations Economic Development Agencies report increasing emerging market requests for technical assistance developing gold-based international trade mechanisms that reduce dependence on existing international monetary infrastructure controlled by developed economies. Regional development banks, including Asian Infrastructure Investment Bank and New Development Bank, incorporate gold-backed financing mechanisms into infrastructure lending programs, providing project financing independence from traditional Western development finance dependent on dollar-denominated arrangements. The story we've explored reveals systematic central bank behavior that operates with mathematical precision, yet receives minimal attention in mainstream financial analysis. Central bank gold accumulation at 60 tons monthly represents more than portfolio diversification. It represents construction of alternative monetary infrastructure that provides operational independence from existing dollar-based international finance. What makes current central bank gold accumulation historically significant is the coordination scale and strategic consistency across multiple emerging market economies simultaneously. This is not random diversification, but systematic monetary architecture development that prepares for international financial arrangements independent of Western institutional control. The transformation continues accelerating as emerging market central banks recognize that traditional monetary theory, assuming dollar stability, may prove inadequate for protecting national economic interests during periods of systematic international monetary transition. If you found this analysis valuable, please subscribe to Unmarked File and enable notifications. Our upcoming investigations examine how these central bank gold accumulation strategies translate into practical bilateral trade arrangements that bypass traditional international financial systems. Next week, We'll analyze how Russia and China have developed gold-based energy settlement mechanisms that reduce European and American leverage over global energy markets. We'll examine the mathematical precision of these arrangements and their implications for traditional petrodollar recycling that has supported dollar international reserve status since the 1970s. The following week, we'll investigate how emerging market central banks coordinate gold accumulation timing to maximize market impact, while minimizing Western interference with their strategic mineral security objectives. This coordination suggests institutional sophistication that traditional Western analysis consistently underestimates. These aren't temporary monetary policy adjustments responding to specific crisis events. These represent systematic construction of alternative international monetary mechanisms that operate independently of Western financial institutional control. The mathematics of central bank gold accumulation demonstrate institutional preparation for monetary arrangements that could fundamentally alter global economic architecture. Thanks for watching Unmarked File. Remember that the most significant monetary system transitions often occur through systematic institutional behavior that operates below mainstream media attention until transformation becomes mathematically irreversible.